Hi, my name is Elliott H, and I'm the editor of the Energy Strategist. I want to talk a little bit today about the global oil markets, as that's obviously been an area of a lot of discussion recently with oil nearing $100 a barrel earlier in the autumn, and then pulling back sharply over the last couple of weeks, followed by another big move up to the upside today. Longer term, I believe the oil markets remain very well supported. I believe that eventually we will see oil prices well in excess of $100 a barrel. My basic thesis has been and continues to be that the reasons that the media has been saying that oil prices have been going close to 100 have not been really the correct reasons for the move. I believe it has mostly to do with supply and demand. If we look at global oil inventories in the developed world, that means oil that's actually in storage and in stocks. It's been drawing down it drew down throughout the third quarter and well into the fourth quarter during a time of year when typically you'll see actually OECD or developed world oil inventories rise. The reasons for that were really twofold. Firstly, non-OPEC production of oil has been coming well under expectations. We've seen several major projects delayed or canceled over the last year. Consider that at the end of 2006, the International Energy Agency believed that non-OPEC production growth globally would total about 1.7 million barrels of oil per day in 2007. When 2007 comes to a close, it's more likely it's going to be around 600,000 barrels per day. So non-OPEC production growth has been about 1/3 of what was expected. Similarly, on the OPEC side, what we've seen is that OPEC hasn't been sending oil to the West in the way it normally would at this time of the year. The easiest way to see that, and this is an index I've been talking about a lot lately and put up several charts, is the Baltic Dirty Tanker Index. Essentially what this is an index of spot tanker rates. In other words, the cost of hiring a tanker to transport crude oil on a daily basis. And what we've seen is that those rates remain very, very depressed throughout September and into October and through half of November. This is seasonally a time of year where you typically see those tanker rates really spike. The reason that happened is that those tankers were just backed up in the Middle East waiting for cargoes to take west. What we actually saw was that they remained depressed because those tankers were just sitting there. Over the last couple of weeks, we've seen tanker rates actually spike. As of yesterday, they spiked to a level that we haven't seen since the end of 2005, so for a long, long time. And I believe we actually have some more upside there, and we might actually exceed the highs last seen in 2005. And the reason that's happening, of course, is that OPEC has finally started to send oil inventories to the West. I believe that although we're seeing oil inventories come down now, counter-seasonally in the United States, we'll probably start to see this oil that OPEC is sending west start to show up in inventory figures first part of next year. The other factor that continues to be an issue for oil short term is global demand. Specifically, we've all seen the volatility in the broader stock markets over the last couple of weeks, and a lot of that has had to do with the credit crunch and expectations that the U.S. economy was going to continue to slow down going into next year. I don't believe that the rest of the world will be totally immune from a U.S. economic slowdown, and therefore I do believe that that's going to start to have somewhat of a moderating effect on demand. So the combination of somewhat looser supplies and somewhat lower demand should conspire to bring oil prices down at some point into early 2008 towards the $70 region. Once again, I don't believe that this is a longer-term problem. I believe that oil is in a nice bull market trend, but short-term we could see prices come down. Now, what does that mean for oil-related stocks? Well, we have to always remember that oil stocks and energy stocks don't necessarily follow the commodity in lockstep. Oil stocks and energy stocks are still stocks. So to the extent that global stock markets continue to correct, we're likely to see more downside and more volatility in energy-related stocks. My view is that you should use this as an opportunity to buy stocks, buy energy-related stocks as we go into the new year. And for now, I would recommend taking a number of hedges in the form of short positions in certain stocks such as Halliburton to hedge the trend short term. Thank you very much for listening to me today.